Hello, Fiona. How are you?
Yes, I'm fine, thank you. How are you?
Yes, I'm all right. Sorry, my computer was sleeping a little bit, so it took a little bit of
Oh,
time to get up.
oh, that's okay.
He had
All
gone for
sorted now.
afternoon.
That's the main thing.
He had gone for afternoon sleep with his master, so it took a little bit of time for him to get up and to get activated. Now it's all right.
Oh, good.
Right. So today I want to start off on a 50-mark question, but what I did was I
Yes.
did not go straight away for a P&L. I thought I will start with the financial position and then we will go
Yes.
for a P&L and a cash flow.
Yes, that's fine.
Yeah, because always from the balance sheet or the financial position, it's easy to explain most of the principles what we have learned. Then we can go
Yeah.
into the P&L. So,
Yeah.
did you have
Okay.
any time to read this question?
I have read through it. Yes. Yeah.
Okay. Okay. So what did you find? You would have found here we have a PAM, a public limited company. They have acquired the shares in G and him. They both are public limited company. Now that's a very important statement. So whenever if there is NCI being valued at fair value, if we have the share price, we can always work out the fair value. Examiner
Yeah.
can't give us the fair value. When they are public companies, we can always work to that one. That is one important thing that we can take it up.
Yeah.
Right? So that's a very important thing. Then the next one. So they are given the date of acquisition. So two important dates always is the date of acquisition and the date of reporting. So I will quickly go. This is the way I will approach these questions, Fiona. I will quickly go and see the date of reporting. I will note down the date of reporting. They say to prepare the consolidated statements as at 31st May 2005.
Yeah.
So that's a very important date. I will keep that in a side in my paper. I will write 31st May 2005. So I will never forget that all what I'm going to do is as at 31st May 2005.
Yeah. Okay.
Because these 50-mark questions, we have to find some method to work through. Some method to work through, because each little line you work, you get marks. So you may not get the entire 50 marks, but if you can get 30 marks, you have done very well. So we have to look at all the time to do the workings and get the maximum marks through the workings. That is one good thing in ACCA. Now CIMA does not have that facility. CIMA does not give you any marks for workings. They have either right
Oh,
answer.
really?
Yeah, because now they don't have, because now it's all objective test paper. So they don't see the workings or anything like that.
Oh, okay.
Now that's a good thing in the ACCA. We get marks for every line. If we can work out the goodwill, we get marks. If we can work out the non-controlling interest, we get marks. Even if we don't get
Yeah.
the right figures, do the right workings, we will get the marks. So because of that,
Yeah.
we must try. We can't. It's not always possible to balance and balance sheet and everything according to the time, but we can collect as much as possible marks. So then the next thing is the date of acquisition. Now G, the PAM has taken in G 1st June 2003, 30%. And on 1st June 2004, 50%. So we are consolidating on 31st May 2005. So with the acquisition on 1st June 2004 of 50%, they have got 80% interest in that company, and therefore G
Yeah.
becomes a subsidiary.
Yeah.
So if I had a little paper, I will put PAM. I'm going to put it something like this to show you. What I will do, I will put a little paper. I will put PAM here and put G 80%. And the next one, 1st June 2004, we had taken in him 25%. So this is what I will do. I will put the dates here. The important day for me is not 1st June 2003. The important day for me is the day I took control, 1/6/2004.
Yeah.
This one I don't have a control. I only probably have a significant influence. I don't know yet, but I believe with the 25% I will have a significant influence. I will just put 1/6/2004 and keep it.
Yeah.
And
Okay.
also in my paper I have written what is my the day that I'm going to prepare the consolidated financial statement. It is 31st May 2005.
Yeah.
So this I will write it and keep in my piece of paper. So now what I have to do is, okay, they have given us lot of information. They have told us the holding acquired, the fair value of net assets, purchase consideration paid. Also they have given us the financial statements as at 31st May 2005. And now I will straightway go into my notes. Following statements relevant to the preparation of the group financial statement. G and him have not issued any new share capital since the acquisition of the shareholdings by PAM. That's a good thing. Otherwise, we would have had more complications. But so far, we have never seen that kind of a question, and hopefully, it will not be there. Subsidiary issuing shares after we have bought the company. The excess of the fair value of the net assets of G and him over their carrying amount at the dates of acquisition is due to an increase in the value of G's non-depreciable land of 10 million and a further increase of 4 million on 1st June 2004 and Haim's non-depreciable land of 6 million at 1st June 2004. So one good thing in this question, we don't have those excess depreciation coming up because what we have bought both the fair value increase is due to non-depreciable assets, the land.
Yeah.
That is something little bit generous from the examiner, but he has told us.
Yes.
Once in a way we get that kind of thing. There has been no change in the value of non-depreciable land. Good. Before obtaining control of G, PAM did not have a significant influence over G, but had significant influence over him. That's a very, very important statement, not for this question, but for another one. Look at on 1st June 2003, they are 30% interest in G. But they say, even with 30%, they did not have significant influence. So, very important thing for us to learn, just because we have 20% or 25% or 30%, it does not automatically say that we have a significant influence. In this case, having 30%, the examiner says no significant influence. Right?
Yeah.
Second one, 1st June 2000 for him, we have only 25%, but we have the significant influence. So with 25% we have significant influence, the 30% no significant influence. That shows one thing, it is true enough. Assumption is when you have more than 20%, there is significant influence. But just because we have 30% or more than 20%, it does not mean we have significant influence. Significant influence is defined as power to, your ability to participate in and to make a significant influence on decision making. So, in G, even though we had 30%, surely still not good enough to have a significant influence. But with 80% coming up, surely we have the control.
Yeah.
Because they did not say anything that even with 80% they don't have. PAM has accounted for the investment in G at fair value, with changes being recorded in profit or loss. Market price of the shares had risen to 650 and there was speculation regarding the takeover bid. So that's all right. And first 2004, PAM sold goods costing 13 million to G for 19 million. So PAM is the parent company selling goods to the subsidiary, and that has happened on 1st June 2004. that date is very important because that is after you became the parent. You became the parent on 1st June and the sale has taken. Therefore, we have to remove the unrealized profit. If it has happened before that, it would have been a different story. He has used the goods in constructing a machine which began service on 1st December 2004. Now that is little bit nasty again. Normally you buy the goods to sell, but here you have bought the goods not for sale, but you are putting it for a non-current asset. Additionally, on 31st March, Pam purchased a portfolio of investment from him at a cost of 10 million, on which Ham made a profit of 2 million. So, him, the associate company, has made a profit of 2 million. Let's look at that one in a moment. These investments have been incorrectly included in Pam's statements under the heading investment in him. These investments have been incorrectly included in the PAM statements. Let's look at PAM's financial statements. It says investment in him, 22 million they are showing. So how much did they pay originally to get that 25%? They paid 12 million, right? So that is one investment. That is correct. Now after that, what is this 10 million? How has it come up? Right? And what they have done is, basically, whatever they paid, Pam purchased a portfolio of investment for him at a cost of 10 million, on which, so whatever they purchased, they would have paid cash and debited the investment with 10 million. That is what has happened.
Yeah.
These have been incorrectly. Pam sold machinery worth with a carrying value which was legally binding, which was that purchaser would pay a non-refundable deposit, followed by 2 installments of 3.5 million, including interest of 1 million payable on 31st and 36th. The purchaser was in financial difficulty at the year end, subsequently went into liquidation on 10 July. 10 June, no payment is expected from the liquidator. Deposit had been received on, but the first installment was not received. Terms of the agreement was that Pam maintained title until the first installment was paid. Machinery was still physically held by Pam and machinery. Note number 3, you can see it has nothing to do with the consolidation. It is parent company having a transaction with a third party, not with him, not with G, right? Some third party. So it's a question of providing for receivables and all that. We will keep that for the moment.
Okay.
Depreciation is that depreciation is charged on 10% on a reducing balance. There are no intercompany groups outstanding. That's also a very generous thing of the examiner.
Yes.
So, once in a way you can be expecting this kind of a thing. It is the group's policy to value the NCI on acquisition at fair value, and that is something which I thought they will give us because they are giving us the market prices. So surely they should be looking at that. The fair value at the non-controlling interest in Group G on 1st July 30, 2004 was 12 million. So we have been asked to prepare with IFRS. Calculation should calculate the figures to 1 decimal place of $million. That's also a little bit of a nasty. Normally what we would expect is this kind of a thing to round it up to the nearest 1,000, but they say calculate it to the $1 decimal place. So that's all right.
Yeah.
So let's look at the 35 marks. Let's not worry about the balance part of all that is. If I can get the 35 marks, I'm more than happy. Right? I have another 15 marks below, but let's not worry about that one for the moment. So probably I would be spending 50 minutes to do this question. Whatever I can do it in 50 minutes, 55 minutes, I will do. Stop it, go to the next question. Because I believe in the 55, 65 minutes, I will get the maximum what I can score out of this. Others, I am going to struggle. So I'm not going to struggle in my exam. I will go to the next question and do. Finally, if I have time, I'll come back and do whatever. Because my best comes at the very beginning. My brain is fresh. I will get the best out of it. So we will start off. We have to start off in consolidation. Consolidation, the best point to start off is to work out the goodwill. The moment you work out the goodwill, you get marks, Fiona. So how to work out the goodwill? Now we have only one goodwill here. Because in the associate company, we don't have a goodwill. we have to only work out one goodwill. That is when we acquired G. Pam acquired G. Now, can you take a pen and a little piece of paper, and can you see how you can work out the goodwill? So remember what are the lines for the goodwill, not to memorize, but we have to start off with the consideration paid. Consideration paid. Right? Consideration paid. So consideration paid is happening on when? It is happening on 1st June 2004. 2004. How much did we pay? 30 million. 30 million consideration paid. Then we have the balance 30%. It has the balance 30% which we bought earlier, paid 15 million. But what is the value of that consideration? The consideration we have paid was 30 million. That's it. That's true enough. And what is the fair value of the 30%? Now what we have to look at is not what we paid. What is the fair value of 30%? How can we calculate that one? For the 50%, we have paid 30 million, right? Yeah. And remember something? We always pay the fair value, Fiona. What we pay is always the fair value. So now, very simple, right? We know for a 50% stake, we pay the 30 million. So, how much would have been the fair value of that 30% stake? Can you think? For a 50%.
So the fair value of the net assets.
Pardon?
The fair value of the net assets.
The fair value, originally we held the 30% interest. No, we must know the total consideration is what we paid today plus the fair value of that 30%. Understand? Plus the fair value of that 30%. So what I'm trying to get at is, what is that fair value of that 30%? So what we know is the 50% fair value is 30 million today. That is the important date, 1st June 2004. If 50% is 30 million,
then 30%, if 50% is 30 million, then 30% would be 18 million.
That's correct. That's all you need to know. Isn't it? That's all you need to know. So that is the fair value of that, the second 30 or the first 30%, the fair value is that amount 18 million.
Yeah.
So that is a consideration what we will be transferring. Not paid because we are not going to pay. So between 15 and 18, what is that one? Originally we bought it for 15 million, isn't it?
Yeah.
Originally we bought it for 15 million. Now it has gone, now the fair value has gone up to 18 million. Now what is that 3 million? What is that 3 million?
That's an adjustment to the fair value. Yeah, so that will be...
that is actually a profit that the parent has made, isn't it?
Yes.
Because the parent bought it for 15 million long time back when I was not a parent. But when I became a parent, I could transfer it at 18 million. So it's a 3 million that I have made, which is a profit for me, for the parent company.
Yeah.
I can consider like that one because it is the extra 3 million which I'm getting is purely coming from the parent. So for the moment, don't worry about that one. So we have paid a consideration of total 48 million. Now, we have to compare what is the next third item. We have to take the net non-controlling interest fair value. Non-controlling interest fair value.
Yeah, that's given in the question, isn't it? Fair value of the non-controlling interest was 12 million.
12 million, right? Yeah. Obviously, we know it is 12 million, so we can add that also. That's awesome. So now altogether, the consideration plus the NCI is 60 million. How much is the value of assets what we are going to acquire? right? What is the fair value of identifiable net assets? What we are going to acquire?
$50 million on the
$50
1st of
million.
June.
Yeah, 50 million. Actually, we are getting only $50 million. That's all. The fair value of net assets, right, on that day is 50 million. What they are given is, you have to understand, what they are given is 1st June. It is not the 50% 50 million, Fiona. It is on the 1st June 2004, fair value of net assets is 50 million.
Yeah.
So 60 minus 50
gives the goodwill of 10.
Gives the goodwill of 10.
Million.
That's simple. That's the one. Now, one area where you could go wrong or make a mistake is to take that 50 million, 50%, 50 million, another take a 40 million, work it out. That is wrong.
Yeah.
Right? Because what they are given is the 3 lines, they are given under 3 columns. The first column is holding acquired. Second column is fair value of net assets on that day. It's not the 50% of net assets. It is the entire net assets 50 million. So now we have done a big one jump. The goodwill we have calculated. Keep that working. You are going to get about 3 marks or 4 marks on the goodwill what you have worked it out now. Very important part. We have worked it. So we have to remember there's only one goodwill here. Now the next one I want to look at is, before I go even into the P&L, I want to look at the investment in associate company. Investment in associate company, at what figure I'm trying to collect the figures to the balance sheet and to keep working. And later on I will teach you how to do it. What I will do is, in fact, I will before I start off all this, I will do a pro forma balance sheet, pro forma statement of financial position. I know my pro forma statement of financial position. What is the heading? PAM Group Consolidated Statement of Financial Position as at 31st May 2005. I will open up a new paper and write PAM Group Consolidated Statement of Financial Position as at 31st May 2005. I will put $million. These are little things which are going to carry marks.
Yes.
You just put up that format. And I will start. I know what is my first one. Normally assets, property, plant and equipment. So I will put up a line saying property, plant and equipment. I will put up the second line, goodwill. Now since I have worked out the goodwill, I can even go and put that goodwill in my statement of financial position. In that pro forma, I can put my goodwill 10 million, 10.0, because you have to prepare it for 1 decimal, 10.0. So I will just go and put in that my goodwill line 10.0, like that. When you do this kind of thing, you get marks.
Yeah.
You don't need to complete the entire thing. Now I want to work out the second line, property, plant and equipment. It will take a little bit of time because there are complications. Investment in associate. Investment in associate. Look at the consolidated balance. Look at the statement of financial position, and quickly we can work out property, plant and equipment. We know investment in G will not come, but we will have a goodwill there. Third line will be investment in associate. Then we have to see then the current assets. Then on the other side it is equity plus liability. So share capital. So you know the share capital is always only the parent. So I can just go and enter that 100.0 straight away. Right? I know because that is the figure. Share premium, I will put up the line. I'm not going to enter anything because share premium I need to work out. But share premium also actually you don't need to work out. It is only the parent company share premium that comes up. So you can go and enter the 50.0 also.
Yeah.
Then we have the revaluation surplus. We can see we don't have any revaluation surpluses in the subsidiary and in the two subsidiary and the associate. So, because if there is anything which will come up, but we can include the 15 million straight away in my consolidated balance sheet. Retained earnings is the next one which I have to work out. I will just keep it blank. Then that all those four lines, share capital, share premium, revaluation surplus, retained earnings, I call equity attributable to the parent. The four subtotals of that one, share capital, share premium, revaluation surplus, retained earnings, I call it equity attributable to the parent. Write that one.
Yeah.
Next line, I know it's non-controlling interest. And with non-controlling interest, what do we get? We get total equity. That's the next line. Total equity.
Yeah.
Then we have non-current liabilities and current liabilities. So I will prepare my balance sheet like that. My statement of financial, just keep one or two blank lines in between if I have to include something which is not, I cannot see here. Just keep one or two blank lines to include it. Otherwise, just prepare the statement like this.
Yeah.
So already now I got the 10 million figure, I have put that one. Already I put the share capital figure 100 million. Already I put the share premium figure 50 million. Already I put the revaluation surplus figure 15 million. Now the next figure what I am going to look at is the investment in associate. Now you remember investment in associate by the equity accounting method. What do? We take the consideration initially paid, which is 12 million. So I'll do a little bit of work in number 2 or whatever. I say original cost of investment in him 12 million. And then what do we do after that, Fiona? What do we do after that? Normally the investment in associate appear at original cost plus
share of profits.
Plus post-acquisition profits, our share, correct?
Yeah.
Post-acquisition profits, our share of the associate company. Now that's the next thing what we have to work it out very, very carefully. Now look at our profit now. What is our retained earnings now? 10 million. As at today, 10 million. Right? As at today, our retained earnings are 10 million. Now I want to find out what was my retained earnings at the day that we acquired the company. That is what I have to find it out. When we acquired the company, what was my retained earnings? You can see the fair value of net assets on that day was 32 million. Right? Fair value of net assets was 32 million. What is that 32 million represents? The fair value of net assets means share capital and other reserves, whatever it may be, including the retained earnings. Correct? That is what the fair value means. But we know in that fair value, there are some adjustments. The 32 million, this figure, I want you to note down, this 32 million figure what you have, it has a couple of components. 32 million figure is made up of share capital. Now the share capital did not change. Share premium did not change. So what is the figure of the share capital and the share premium? 32 million is the whole figure, but we have a 6 million and a 14 million share capital and the share premium. So if you take that out of 32 million, that 20 million, what is our retained earnings on that day? 12 million, correct?
Yeah.
But we have another adjustment. You remember they say when they took the company, they did a fair value adjustment of the land. Land, they did a fair value adjustment of 6 million. 6 million. So that 32 includes that 6 million that 14 million and that 6 million. 6 million and 14 million are the share capital and share premium, and also it includes that excess adjustment to the fair value. So now if I go back on the reverse, I can find out what was my retained earnings in my financial statements on that day. 32
Yeah.
minus 6, that is the fair value adjustment for land, minus 10, sorry, minus 6 share capital, minus 14 share capital, share premium. I know my retained earnings figure at that time would have been 12, 26, 6. 6. Now what is my retained earnings, Fiona?
So that is 4 million.
4 million is my post-acquisition profit, isn't it?
Yeah.
4 million post-acquisition profit. How much am I entitled?
Of the 4 million,
Yeah. Of the 4 million, how much am I entitled? What is
in
my...
HEM,
Yeah,
25%.
25%.
Yeah.
25%. Out of 4 million, 25% is 1 million. Correct?
Yeah.
So, your investment in associate company will appear at 12 plus 1. That's all. That's all. So, you got another big figure into your balance sheet. 12 plus 1 is 30. So, I got that one also out. So, that's the way, step by step, just go on. So, I got the investment in associate. I got the goodwill into my balance sheet. I got the share capital, all that already in the thing.
Yeah.
Now what I can do is I can look at the consolidated retained earnings. I think now I'm in a position to do the consolidated. That's a big one. I do this one, I have completed half of my question. So the consolidated retained earnings, the best thing what you can do is just have 3 columns. One for one for Pam, then we have G, then we have him. Start with the profit figures they have shown. Start with the retained earnings they have put it up. What is the retained earnings they have put? All these carry marks. 139.
So, yeah, 16 and 10.
16 and 10. Start with these figures. Now what you do is you straight away go into your subsidiary figure, look at the 16 and see, now it is 16. What should have been my figure on the day of acquisition? Same adjustments like what you did here, right? So remember when we took the subsidiary, what was the fair value of subsidiary net assets? So we have now 16. They basically told us the value of net assets. That one from our question. Yeah. Yes, we can pick it up because we know. You remember the examiner said here, investment in G. G have not, before obtaining, did not have. PAM has accounted at fair value with changes been recorded in profit or loss. So what we know is the 52 million what we have today is the fair value. Because they have recorded it at 52 million. If this is very easy because we have that one, but otherwise I have another way to work it out. You remember they have 80% interest. What's the total share capital of G? 10 million, right? 10 million, $1 shares, 10 million.
Yeah.
We have 80%. 80% means 8 million. The market value of share is 650. 650 into 8 is 52 million. That's another way to get. But I don't need to go by that line. I have the fair values already given by my examiner and I know the value is 52 million. So what I have to do is now I have to go back on the reverse and reverse all the entries. So on 52 million, I know there was a revaluation, the land adjustment came something. What was the land adjustment brought me? Just like in the him, land adjustment brought me something like 14 million in and a 4, correct? In and a 4. There was a 10 million on 1st June 2003 and another 4 million on 1st June 2004. So 14 million. In this fair value, there is the fair value adjustment of 14. Remove that one. Remove that one. And remove the share capital and the retained earnings, the share capital and the share premium on the day of the what we have. Right. So the share premium and the share capital is 10 million and 21 million. Remove that one. Once you remove that one, what will you get? You will get your retained earnings on that day. 52 million, right? Now you will get your retained earnings on that day. It is 52 minus 14 minus 10 minus 20. How much is that? 24, 44, 30, 24, 44, 50, sorry, 50.
Yeah, 8.
How much? Yeah, 8.
So that leaves 8.
Yeah, that's correct, right? So that's the retained earnings what we have. The retained earnings. No, I just want to. I think I have made a mistake somewhere. Just a minute. Give me a minute. No, fair value of net assets is 50 million. Sorry, I made a mistake here. Fair value of net assets is 50 million. So 50 minus 14 minus 10 minus 20. 50 minus 14 minus 10 minus 20, how much? It is going to be the day that we acquired, we had a 50 million net assets. 14 was the increase due to the land. 10 was due to the share capital, 20. So that means it is the 14, 24, 44, 6.
Yeah, 6.
Now what is our retained earnings? 16.
For him.
Yeah. For G.
Sorry, for G. Yes, 16 was the
16 is the figure
post
now.
acquisition.
16 was the figure
6.
now, and at the beginning it was 6. So that means what is our post acquisition profit? 10. 10. How much we are entitled of that 10%? 10.
80%.
80%. 8. So I can take 8 straight away, isn't it?
Yeah.
I can take 8. As far as him is concerned, we saw it was 10 now, but we saw earlier we did that calculation. We had a post-acquisition profit of 4. So because we removed 6 out of that one, so we have a 4. Out of 4, 25% is 1. So I will take 1 associate company share profit. Right. So now I have got the 2 main areas cleared. One was on the him, one was on the J. Both those areas are now cleared for me. Now I have to work out only one couple of things. One, what I have to work out is the PUP on machinery. So remember these figures, 139 I have the 8 and I have a 1. Keep those figures. I'm now going to go into the machinery figure, which is a bit of a tricky one. We will look at that. PAM sold goods costing 13 million to G for 19 million. Right? G has used the goods constructing a machine which began on 1st January 2004. Additionally, on 31st March, purchase of, forget about for the moment that purchase of that one. So let's look at the PUP on machinery. PUP on machinery. So the profit, intercompany profit is how much? 19. What is costing 13? They sold it for 19. right? So they sold it for 19. So then, where after selling for 19, they have so they would have taken it as 19. So there's excess 6 million where our property or the plant is reflected at excess 6 million, right? And the machinery, what they say is, machinery, they say it will be depreciated at 10% on reduce in balance. So on the 6 million, there's a 10% depreciation, which is 600,000, right? Which is 600,000, but not for the entire year. When did this transaction happen? Transaction happened on 1st 2004. The machine was constructed on 1st December 2004. Where are we now? We are on 31st May 2005. 6 months have gone.
Yeah.
6 months have gone. So even though I have overstated my parent company profit by 6 million, 13 to 19, because of the excess depreciation on that 6 million, how much is the excess depreciation? For the full year, 600,000. For the half a year, 0.3.
Yeah.
So my unrealized profit is 5.7 million. 5.7 million. So originally, what is the figure that we had in the consolidated P&L? We had the parent company 139. We had another 8 million. Then we had another 1 million. And now we must remove 5.7 intercompany profit, provision for unrealized profit.
Yeah.
Then we have this investment. The PAM purchased a portfolio of investment from him at a cost of 10 million, on which him made a profit of 2 million. So when him makes a profit of 2 million, now we took that entire profit into our P&L as post-acquisition share, right? Because the him's profit, whatever the profit, we took a 25% share. But now we must realize that him has made a profit of 2 million by selling something to the parent company or to PAN. So on that 2 million, 25% of that is an unrealized profit.
Yeah, 0.5 million.
Not 5 million, we have to remove it from the parent company. Why we remove it from the parent company? It is reflected in the associate company, but we took the entire profit of associate company, and therefore this 0.5 should be removed from the parent. Right? So that's another adjustment what we have done. So to best of my knowledge, I think we have done all the adjustments. We need to look at one more thing, the fair value gain in J's separate statement. So we have the 100. So we have to look at how much we have reflected in the question, because the parent company profit is 139 million. In arriving at 139 million, how much is included as intercompany profit? Intercompany profit. Now you remember the fair value of 80%, 650 into 80 is 52 million. 52 million, right? So that is what they are reflected in the balance sheet, 52 million. But what is the fair value of what we bought? 50% when we bought. When we bought the 50%, the fair value of that was value of 50% what we bought, 30 million. Purchase consideration was 30. You remember? It was 30 million. And also we saw the fair value of that earlier 20% what we had, the earlier 30% what we had, we worked it out. If the 50 is 30 million, we said 30 is 18 million. So we know that is 18 million. So the asset is now appearing at 52 million. What is the total fair value of both these acquisitions? 30 plus 18, 48. So there's a 4 million profit in that 139 reflected as intercompany profit, which we need to remove it. So if I go back now, I have 139. I have the parent company 8 million, subsidiary company. I have the associate company 1 million. I have unrealized PUP 5.7 on the property. I have associate company unrealized 0.5, and now I must remove this 4 million because it is also intercompany. I have gone from 52 to from 48 to 52 by taking 4 million credit, remove that one also. Remove that one also. So now consolidation adjustments are done. Now I need to do one more. So I hope you will keep all the work in. I'm going to do one more adjustment, that impairment loss for the non-receivable. That's the only thing we need to work it out. Impairment loss for non-receivable. So that has consolidation. Let's look at what happened here. PAM sold machinery with a carrying value of the contract which are legally binding on 28 February 2004, that the purchaser would pay a non-refundable initial deposit of 2 million, followed by 2 installments of 3.5 million, including total interest of 1 million. So the machinery total sale price would have been 2 plus 2.5, 4.5, with the interest element of 1 million. That is how they would have got the entire 5.5 million. Payable on 31st May 2005 and payable on 2006. Right? The purchaser was in financial difficulty at the year end and subsequently went into liquidation 10 days after our balance sheet. No payment is expected from the liquidator. Depositor had been received on 28, but the first installment was not received. Terms of the agreement was such that the PAM maintained title to the machinery until the first installment was paid. So surely the first installment was not paid, and therefore the title will never transfer. Machine was still physically held by PAM. So we are not even sold the machine, and the machine had been treated as sold in, even though it is physically there, we have treated it as a sale in the financial statement. In the financial statement, amount outstanding 6 million is included in the current assets. No interest had been accrued in the financial statement. So here we have to think very carefully and see what are the figures we should be looking at. So the cost of machine is how much? The machine PAM sold with a carrying value. Yeah, I think there's a figure here. PAM sold some machinery with a carrying value of 8 million. That was the cost. 8 million, right? So remember that one. Here there is a little figure.
Yeah.
8 million of the content, which are legally binding. And so the total carrying value of the machine was 8 million. How much they have received as a deposit? 6 million, 2 million. We have already treated this as a sale. And we are now showing, so how much we have to write off as a bad debt? It is 6 million, we have to write it off. Because we sold it as 8 million, we got a deposit of 2 million, so we have to write off 6 million. Right? We have to write off 6 million. So now what we have to see is, because we are not going to transfer the property, what is the value we can always take it up here? Right? What's the value we can take it up? So machinery, now I think I have, PAM sold, just give me a minute, I want to see the original sum with the carrying value of which are legally binding on, was that the purchaser would defer 2 installments. The purchaser was in finance, no payment is expected, but the first installment was not, terms had been until the machinery was physically held by and the machine had been treated. The amount outstanding is included in the current assets. No interest had been accrued in the financial statements. Okay. I am sold a machinery with a carrying value of 8 million, which was legally binding. I'm sold the machine. No. Yeah, Pam sold a machine. There's something missing in the question. Trying to find out what is missing. Pam sold a machinery with a. Give me a second, Fiona. I want to see the question again.
Yeah.
What is the question? Sorry, just note down the number 3 adjustment. Pam sold the machinery with a carrying value of 5 million.
Yeah.
5 million on 28 February 2005.
Oh, that's missing off here,
Yeah,
is
that's
it?
missing there something, yeah. Pam sold the
5
machinery
million.
with a carrying value of 5 million on 28 February 2005 for 8 million. For 8 million.
Yeah.
Right? Then it says the terms of the contract which are legally binding. After that it is all right. From 28 February it is all right. So there's a little bit to add. Pam sold machinery with a carrying value of 5 million on 28 February 2005 for 8 million.
Yeah.
So now let's look at that one. Otherwise I could not have done the calculation. So now let's look at what is happening. So here we have a machine which is worth 5 million. We sold it for 8 million and we have recovered 2 million from them. So there is a 6 million which we have to write it off as a bad debt.
Yeah.
Right? Which we have to write it off as a bad debt. Now what we have to look at is what is the net book value of included in the tangible assets. Right? In the tangible assets, what is the net amount to be included? Because the machine was worth 5 million. The machine, the carrying value was 5 million. So when it is carrying value of 5 million, we will be depreciating that one. If it is not sold, we will be depreciating the machine and how much depreciation we will be providing. We are going on 10% depreciation. So on the 5 million, 10% is 500,000. We will be depreciating it for 3 months. Right? We will be depreciating it for 3 months because legally binding on 20th of February. So we are on the 31st May. So we will be depreciating it for 3 months. So 5,500,000 and on that one, 3 months is how much is that? 125,000, is it?
Yeah, 125.
But we will go for the one digit, single digit. So because of that, it will be 5 million. We will provide 0.1 depreciation. The written down value of the asset which we can take back to our asset account is 4.9 million.
Yeah.
So the total bad debts to be written out was 6 million, but we can recover 4.9 million from the machine, which we will take it back to our assets. So the ultimate net amount to be written off will be 1.1 million.
Yeah.
6 million minus 4.9, 1.1 million. So now if I look at my consolidated retained earnings, I had 139, I had 8 subsidiary profit, I had 1 million, I had a 5.7 million write-off, the unrealized profit, I had a 0.5 unrealized profit, then I had 1.1 impairment now coming up from the non-receivable. Then also another 4 million intercompany I must write off. Can you quickly calculate and tell me what is the consolidated retained earnings will be?
Yeah.
139 plus 8 plus 1 minus 5.7, minus 0.5, minus 1.1.
Yeah. Oh, hang on, I just need to do that again.
That's okay, no problem.
$139.7.
139.7 or 136.7? 139 plus 8 plus 1
Yeah.
minus 5.7 minus 0.5
Yeah.
minus 1.1
Yeah.
minus 4.
Yeah.
How much are you getting?
Yeah. I've got 139. Where should I get that from?
Yeah,
retained earnings 139.
139 plus 8. Sorry, 139
Yeah.
plus 8 plus 1.
Yeah. So 139.7.
139.7. Okay, keep that figure as it is.
Yeah.
Right? Keep that minus. You took the minus 4, no?
Yes, -4. Yeah.
Keep that figure as it is. Let it be as it is because I want to check my calculations and see whether I have made a mistake. But don't worry. Just keep that one as it is. Yeah, -4. Yeah, I get 136.7. Where did I go? Can you again look at 139?
Yeah.
Plus 8.
Yeah.
Plus 1.
Yeah.
Minus 5.7.
Yeah.
Minus 0.5.
Yeah.
Minus 1.1. Minus 4.0.
136.7.
Yeah, okay. That's the figure I got, 136.7. That should be all right. 136.7. So, let's look at a little bit one more. The non-controlling interest. That's the next big one. So, let's look at that one also before we find out. Non-controlling interest. So, non-controlling interest, they say at the beginning, it was 12 million.
Yeah.
Say non-controlling interest at the beginning was 12 million. Right? And what is our post-acquisition profits of the subsidiary after deducting all that? It was 10 million. 80% we took, 20% belongs to them. Isn't it? So the non-controlling interest will be 12 plus 2. It should be 14.
Yeah.
So now we have got almost all the figures. You have just little bit work to be done. I want you to try that one. We will look at tomorrow. Tomorrow we have a meeting?
No. Is it tomorrow? Yes, at 11 o'clock.
Yeah, tomorrow we
so
have
it's a bit later tomorrow.
Tomorrow at what time your meeting?
11.
11 your time, no?
Yeah, 11 my time. So 2 hours later than today.
All right. Yeah, that's right. Yes, I marked it. That's all right. Yes.
Yeah.
Right. So before we come tomorrow, can you see whether you can now balance the balance sheet? You have to only work out one figure. It is the property, plant and equipment.
Right. Yeah. Okay. Yeah.
Just try. Don't worry. We will do it together. But just try whether you can work out the balance sheet. We have got almost all the figures now. Worked out. So we only have to see whether we can get the balance figures out. So just try, because we have already got the goodwill figure. We have got the investment in associate figure. We have to just work out few more figures. Just try. Current assets, I don't think there'll be big thing. But just try reading the question now. We got the big figures out. Do it. Tomorrow once we meet, we will do the balance part of it.
Yeah, so do you want me to send you my answer to it?
Very good. If you can, yes, that's a great thing. Yes.
Yeah.
Yes.
Okay. And
Yeah.
did you have a chance to look at the answer I sent you from the last time we met?
Oh, I didn't see that one. Did you send me something?
I did, yeah. That would have
Okay.
been Sunday, yeah.
Sunday was today is 12th, no?
Yeah, the 12th, yeah.
12. Ah, yeah, there's answer. Yeah, you send it something on the 13th. This is that. Yeah, that's right. I will do that one. Sure, I will do that one today. Yes.
Okay.
Yes,
Yeah.
I will do that one.
All right then.
Okay, I'll see you tomorrow.
Okay. All right. Thank you.
Take care. Have a
Have a
great
good day.
day. Bye.
You too. Bye.
Bye.